good day, colleagues. Today we are going to have a virtual Zoom call where we take a look at a real-world business valuation. And I'm going to share my screen here, and let me know if it's not visible. Please start yelling, but you should see a spreadsheet with a large yellow text box. And I'm going to walk you through this spreadsheet. And again, it's a real-world example that I've used with a client. However, we protect our clients' privacy and data, of course. So I've redacted all industry information, all the numbers have been changed, everything's been changed so that I can use this actual example. So this is a high-level view. It's actually more complex than this, but it's kind of a fun example. And I hope it sparks thought in terms of how to consider valuing something and how you might look at various scenarios rather than just taking the first answer you get. So in this case, we're going to, we'll start a general rule with any sort of analysis is making sure you have a clear understanding of the problem and the objective. And so today, it's really just to say, what sort of price might we be willing to pay to acquire a certain business? And we'll show you more details in a second. This is a financial-based valuation. So the very first real step then with work is to take a real quick look. Well, that's not true. A real long look, but today it'll be quick at the input financials. I'll show you how to do a base valuation model using a certain method. We'll take a real quick look at some variables. We'll develop some standalone cases. And then the real reason you do an acquisition generally is around synergy. You think your client, by acquiring some other company, is going to create more value. So, peanut butter and chocolate, something like that, where the two of them together create value beyond what either of them can produce by themselves. And we'll take a look at those synergistic cases. So with this particular one, we start with data that the client's acquisition target had provided, or they were able to get on themselves. And we're not going to go into these in great detail. So don't worry if you're not like an accountant or a finance person. It's just to say we start with actual data from the client. And again, this is all redacted and randomized, so there's nothing confidential, but we start with their income statement and their balance sheet. And often we go through, we make sure that we feel comfortable with the values they provided if they're not audited statements. And we often would do some corrections. In this case, I'm just taking the income statement and I'll show the balance sheet as well. And these are pretty simple. It's actually, the target is actually a European company, so all the values will be in euro. But we start fundamentally, we're building off their income statement because at the end of the day, we're buying a business and we want to purchase them in order to get their profits and ideally improve upon those. So the very base foundation for the analysis is the income statement. And we go then and we start thinking about what is going to happen with this company. One of the first things we do is think about, say we weren't the one purchasing them. It's just a standalone business and they exist in an industry, this target company. And we might ask ourselves, what is likely to happen to this target company? And you do the same thing if you were looking at buying stock in a company, you'd probably do exactly this thing. Because if I buy 10,000 shares of any given company, I'm not going to create synergies by doing it. It's a standalone acquisition. And so the same is true here. And so the first thing we do is think about what might happen to our target relative to the industry. And there's some assumptions in here and we won't go into the details, but that's fundamentally what it might look like. And so we actually will do some valuations based on that. In addition, we think about what global variables might apply. And I'm not going to go into details, but for a spreadsheet like this that we'd use again and again and again, we often set things up like this. And so things like, how much are we going to discount their profits using a cost of capital, marginal tax rates, and a bunch of other things that I won't go into detail other than, they probably have some debt that we're going to need to remove from the valuation. There'll probably be restructuring costs, things of that nature. And the third thing I'll just talk about briefly is around synergies. And it's a little more complex here, but remember, we're starting with an income statement. And so when we start to think about what can our client do with the target company, we start to think about, okay, maybe a reason to do this is they're going to increase sales of some redacted product over in the EU. And that's pretty exciting. Or maybe they're going to start sales in the US and Australia. And so all of these then will apply to something in the income statement. And this is a simple one. So we're only going to impact revenue, so sales, or we're going to have some beneficial effects in things like purchases. So, the things they buy and resell, we're going to reduce their cost of goods sold, or we might reduce some of their other operating expenses. And so this is a way to structure lots and lots of potential synergies and have them apply. And we won't go into detail other than to say, we have four cases for synergy. And I realize this might be a bit hard to read, but in some cases there's no synergy, low synergy, medium synergy, and high synergy. And for all of those, we sit down with the client and we find some way to figure out what those might possibly be. And in some cases, they could even be negative synergies. You might acquire somebody and it's going to alienate 10% of their customers and you'll lose them, which very often could be the case. But maybe you make up for it because you're able to sell more in your home market, or maybe you're able to charge more for the product or reduce costs, something of that nature. And then there's some math to sort of accumulate the results of these over the future years. So all of these potential synergies apply to various parts of the income statement. They accumulate together. And then at the bottom, for those that we've selected and decide we want to actually do work with, we aggregate those results. And so let's go. Let me show you this because it'll be a simpler example. So first, I'll only show you this little section is where we're thinking, we're not looking at synergies yet. We're just thinking, say we buy this company, how much might we be willing to pay for it, assuming that there's no beneficial or negative effect. We're just buying a company. Here's what they might be worth. And I'm going to show you how we come up with these numbers. And so these were based, remember before, we looked at the baseline industry results. And so we kind of think the base case is worth 5 million euro, but it might be worth as little as 4.6 or as much as 5.6, depending on how we think the company will do relative to the industry. And so we'll go over and take a look. Here's the base case with no synergy. And you'll note for every single baseline case, there's 4 examples. So there's 4 worst line cases, 4 base cases, where we're just thinking about the industry. And then with each of those, we also think about synergies. So these 4 in yellow are where we think there's going to be just base industry cases, and we're looking at the various synergies related to those. And I know this is going to look complicated, and I apologize for that, but that's okay. We take their income statement and we think about what is going to happen with them relative to the industry. And all these numbers came from before. In this case, we only think what's going to happen there will apply to sales. That will, of course, have effects on things like your total cost of goods sold, because if sales go up, say 3%, if nothing else changes, your cost of goods sold has to follow suit. So over here to the right is where we just model all of those things out. And so it just flows very evenly across. In this case, we're only looking at industry base values. We're not adding any synergies yet, but you can see where these will start to roll in when we look at the cases where there's synergy. So those collect up into future income statement items as shown over here. And so we have 3 years of history. We're forecasting 5 years to come. We're simplifying things greatly in terms of mid-year forecast and all that sort of stuff, just to keep the case simple. So at a base level, we're forecasting future income statements as shown in these 5 columns. Down at the bottom then, we collect those up and we start doing some work against them. And I'm not going to go into detail at all, other than I don't know how familiar you folks are with acquisitions, but generally what you want to get to, what you're buying with any company, is access to their profit. That's the fundamental thing. You don't really care how much they sell. You don't really care how much debt they have. What you really want, what you're really buying, is access to their profit. And the most common industry way to look at that is free cash flow, which here I just have as FCF. So we take each of those years, we guess what we model what their free cash flow is likely to be. Let me expand this just a little bit. And then we discount it, because as you folks probably know, $1 a year from now is worth less than $1 today. So we just apply our discount rate to bring those dollars back to present value. And we do that for all of the years, And of course, year one, we're saying $1 a year from now is worth 91 cents today. 2 years down the road, though, it's worth even less. It's worth 83 cents, 75 cents, 68 cents. It's a very, very common financial technique. I would argue that finance fundamentally just translates capital across time and risk. And so that's fundamentally what we're doing. And so for each of these years, we're taking free cash flow and discounting it back to present value. So PVFC, this just means present value of the free cash flows. So we have those for each of the 5 years. And if we add those together, we'll see at the bottom of the screen, that totals to $3.669 million. And that is that result there. The one other thing we add to this is we're not just buying access to 5 years of their profit. There's this, it's essentially infinite. And so a common industry technique is to just use a terminal value. And what we do is we take some of the cash flows, we remove a lot of accounting stuff related to that. So things like depreciation, working capital, all these sort of things, we're going to just wash those out to clean things up. And then we multiply it by a multiplier. And this will depend on industry and risk and your client's appetite for both of those. But we use a multiplier and essentially we say, okay, the first 5 years that we're forecasting, we think that is in today's dollars worth about 3.7 million euro. The remaining infinite number of years we think is worth about 11 million euro. And together, those things create an enterprise value of about 14.7 million euro. From that, we just subtract out debt, which the target has on their own statements, and we have an estimate for restructuring costs, giving us what we perceive as an equity value, what we think it might reasonably be worth in this particular case of around 5 million euro. So this was the simpler example with no synergies whatsoever. I'll show you one more case and then we'll just jump to the summary and we can have questions. Here's the same sort of analysis. The only difference is now we're also adding in some synergy values. And so we actually think in this case, we're going to lose some sales in the first couple of years, and then sales will start to pick up again for a couple more years. And this can happen for a lot of reasons. Customers might be alienated. There might be some issues with the channel. There could be brand issues. Lots of things can affect that. However, there's a good guy here as well. We do think that we're going to see some beneficial effects from things like purchases and services, though. So maybe, we both provide similar products and we can, get some cost concessions out of suppliers, or there's efficiencies in manufacturing. So I won't go through, there's a whole bunch of cases like this across these many sheets. I think there are 1, 2, 3, 4, 15 of these, but they all come together in our summary sheet. And so now we talk about the base. Here we are, and we're pulling values from each of those sheets, and I'm using cell labels in Excel just to make it a little easier. But for each of the cases, we have our standalone value, and then we have 3 synergistic cases. So generally, we might think, okay, we think there's going to be medium synergy between the client and the company they're acquiring, and we think they're going to perform about baseline relative to industry, giving a value of around 13.7 million euro. One other synergistic case we do, in this case, I do a probability weighted approach to it. You could just as easily do, say, a Monte Carlo approach, where you're just curious. There might be a lot of variables you want to look at independently and then collectively. So there are quite a few potential results in this table. And so the chart below, and this is just a 3D bar chart, which Excel, sometimes these can be hard to use. This is a really good case where we've got fairly orderly data. I don't even bother to chart across the bottom the standalone values, because we know our acquiring client is going to bring some synergies. However, we do a cool thing with the cell labels where we put the values in the series labels so you still have reference to them. And so if you are my client looking at possibly acquiring this target company, this is sort of the range of values that this might be worth to you as the client. And so somewhere between what it might be worth to you all the way down to what the target might be willing to part with the company with, that's where you strike a deal, right? Because as the client, you don't want to pay the full price of what it might be worth to you, because then you're not getting anything. Even if you've actually perfectly analyzed what this thing might be worth, you're not able to glean out any additional profit. You want to be somewhere between the least the client is willing to part with it for, the least the target is willing to sell it for, and what your client is willing to pay for it. So fundamentally, this is a basic approach to valuing a business. I realize it might be, I don't know how deep into the weeds you guys are on these, but it's super fun. And it's a good way, even if you buy stocks or you're looking at selling your own company, it's a good way to think about what a business could be worth to an acquirer or to a purchaser. So with that, I'll shut up for a second, give you folks the chance to either ask questions about this specifically, or if you have more general Excel questions, we can sort of jump into those. So with that, thank you for letting me excel today.